Welcome to Show Me the Money with Michael.derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business and all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. On this episode of Show Me the Money, we are going to have Mr. Jerry Fink. Jerry Fink is the founder, president, and CEO of Bascom Real Estate Group, and is really a legend in the industry, having transitioned almost 158,000 apartment units over the years. He's very entrepreneurial, very innovative. He's a pioneer in the business, and he also helps young people grow in the business as well by potentially just being the equity while they're the sweat equity, which is really impressive for someone at his level. So I hope you enjoy this episode, and I think you'll learn a lot. Thank you. Welcome to the fourth episode of Show Me the Money. I'm your host, Michael.derk. Our guest today is Mr. Jerry Fink. Jerry is the founding and managing partner at Bascom Group, where he oversees property acquisition, financing, refinancing, and disposition. Over the past 26 years, he has developed the firm's investment strategy of acquiring and repositioning undervalued and distressed multifamily assets. In his career, he has overseen the acquisition and disposition of over 157,686 units. Yes, 157,686 units. That is not a typo. For total transaction costs in excess of almost $21 billion. Prior to founding Bascom, Mr. Fink acted as a senior acquisitions and sales manager from 1991 to 1995 for Pacific Mutual Life Insurance Company. Mr. Fink holds a bachelor's degree and MBA in real estate and finance from the University of Wisconsin-Madison, where he previously served on the real estate board of directors of the Wisconsin Real Estate Alumni Association. He is a member of the Institute of Real Estate Management, IREM, and Turnaround Management Association, TMA. Mr. Fink is a licensed real estate broker in the state of California, a certified commercial investment member, CCIM, certified property manager, CPM, certified mergers and acquisitions advisor, CM and AA, and certified turnaround professional, CTP. He is currently a member of the USC Luss Center for Real Estate Executive Committee and serves on the board for the Young Presidents Organization, known as YPO, California Coast and California Coast Gold chapters. He has received dozens of awards and recognitions over his career, including Apartment Executive of the Year by the Real Estate Conference Group in 2004, and also the Rising Star Award by the University of California Irvine Center for Real Estate in 2008. Also, Ernst & Young Entrepreneur of the Year for Orange County in 2016. First, I want to say, Jerry, thank you for coming today. It's an honor to have you on the show. And I know we've done a lot of business over the years, and I'm just thankful you're here. Why don't we just jump right into it and say, what does the last year look like for you as far as investing in your multifamily assets, given the transitional time that we're in right now, maybe from a construction, repositioning, and stabilized basis? If you can kind of touch on all three of those, what you're seeing right now in the market. What does that last year, 2022, look like for you?
Well, Michael, thank you for the opportunity to be on your show. And the past year has been the craziest year I've ever seen. Pre-first quarter of last year, cap rates were in the 3 to 4%, sometimes high 2%. You could borrow 75 to 80% at, all-in rates in the threes. And you saw double-digit rent increases in most markets, especially the Sun Belt. So crazy things happened. Cap rates plummeted to those low levels. And again, the Sunbelt markets, which were historically 5 to 6% plus. And so it was this magical window of time in the apartment world where you can get high leverage, big rent growth, borrow super cheap. And of course, the first quarter, it all ended. Interest rates were shot up by the government. Inflation picked up. And then in this past year, cap rates went from 3 to 4 to 5 to 6% plus. And the outlook turned negative of, rents are going to go flat, maybe they go negative. And so the whole world changed. Also what changed is the public REIT markets, especially the apartment world, plummeted in value. And Green Street always says the public REITs are the biggest indicators of future private real estate. And so those dropped 15, 20, 30%. So you've seen the public REIT markets take a big plummet. The private market cap rates went from, again, 3 to 4 to 5 to 6% plus. And so the whole world changed. And now we look at this recession is going to hit. Are we going to see negative rent growth? The 10-year Treasury went from 1.5% to 3.6%. Leverage went from 75% to 50% or lower. So it's been a huge change in the world of apartment investing this past year. So that's just a quick summary of what I've seen, and it's made buying difficult because the sellers are in shock that the cap rates moved up that fast.
Right.
So most people are fearing, well, why sell now? I don't want to sell, at the bottom. Maybe cap rates will drift back down. So it's been a crazy past year, and I thank God for all the properties we sold, pre last year. We were a big net seller, pre kind of first quarter of last year, and it wasn't that I saw any vision. It's just cap rates were low. We hit our exit. And so we're big net sellers and had a difficult time buying properties. So our portfolio probably shrunk 2/3 in unit count and value with sales. But now I look back and say, thank God we did that, because it's, again, cap rates are materially higher.
Right, for sure. And are you seeing the value add opportunities, which Bascom, obviously, and your whole MO on VF and whatnot you've been absolute rock stars at that across the United States. Are you seeing those opportunities dry up because of, the capitulation as far as cap rates not really moving up, interest rates moving up, the amount of capital and leverage on a very limited basis due to the exit strategy not being there? Are you having those opportunities as an issue, or are you starting to see more of those opportunities come to market as we speak?
Well, last year we didn't see a lot of transactions because the sellers, again, were in shock that cap rates moved up so much. And we were in shock. We'd run models and go, I got to buy this at a 5 cap rate. We looked at a Class A property in Orange County, which would have been a 3 to 4 cap rate any time of the year, past couple of years. And the best offer they got was a 5 cap rate. And, I sat down and how can this be? I looked at our model, but when you plug in low leverage, higher debt costs, modest rent growth assumptions, that's kind of the answer, is that 5-ish cap rate plus. So, that's been kind of the biggest change, is really the underwriting of apartments has changed because you get lower leverage, higher interest rates, and now we've got a much more negative outlook on the future of rent growth as we go into a recession.
Sure. Yeah. And obviously that correlates to jobs. And one thing that echoes on that, we just closed last week, very fresh data, 128 unit building in Whittier, Class A, 1-year-old, Fairfield, big, sellers, the developer there and whatnot. And, that deal traded on real underwriting, real numbers at a 5.28 cap.
Yep.
So that information is going to be hitting comps and CoStar, and people are going to be looking at their 60s and 70s building at a cap rate much lower, where they're probably close to market on the rents.
Exactly. Well, that example, Michael, is the one I was referencing, the 5 cap rate. And I talked to our acquisitions group, and they go, hey, we can only get to a 5. We're at a 5 cap rate. That's when numbers work. And, I sat down and looked at the model, but when you look at the current debt, interest rate, rent projections, it's a 5 cap rate, which would have been a 3.5 maybe a year ago or 2 years ago.
Right. And we hit an anomaly when the treasuries dipped about 4 or 5 weeks ago. We were able to we locked originally at like 5.3, which the deal was really shaky. We had a one-time dip and able to relock that deal at 4.73, which allowed the buyer to get to 62% leverage, which we're not seeing a 6 in front of LTVs today on any kind of quality asset, unless it's a bridge loan or something where we're doing a large earnout basis. So,
but you bring up a good point, which is, if that Class A property in Orange County is a 5 cap rate, newer construction, what's a Class B or a Class C? And you go to the Sun Belt and it gets worse. So it's been a big kind of destruction value this past year and a big plummet in values and increase in cap rates. So it happens so fast and so quick, it's a shock. And I even go to our staff and I go, I can't believe cap rates are this high. They go, look at the model, plug in the debt, plug in the leverage, the interest rate, in the rent growth projections, and that's the answer.
Right. And in turn, obviously working for a large investment brokers like Marcus & Millichap, we've seen volume transactions, like you said, go down exponentially. You know, with the tightening of the balance sheet, the rising of interest rates, sellers are just like, well, what are you talking about? My property was just worth this 90 days ago. How could it be worth that much less? Buyers are like, well, it might be worth less than 90 days from now. So why would I even jump on that? So we definitely have that disconnect in the market as far as the buyers and sellers go. What do you foresee bringing that closer together as far as, you know, do interest rates have to drop? Do sellers have to meet the market? Are we just going to get real motivated people with debt, divorce, partnership dispute, funds sunsetting? What is going to bridge this gap? Or do you foresee this happening for the next 12 to 24 months?
Yeah, we think it's going to be a slow period here the next 6 months, but probably around June of this year is where LIBOR is projected to hit close to, or SOFR close to 5%. And we see the biggest distress in the value-add, higher leverage market where somebody bought a multifamily property at a 3-ish cap rate year and a half ago, 2 years ago. You know, they've had good rent growth. Maybe that's at a 4, but the cost of debt now is, if LIBOR hits 5 and they borrowed 300, 350, 400 over LIBOR, they're close to 8 to 9% debt service costs. And if you bought at a 3.5 cap rate, you just can't move the NOI fast enough. And a lot of those loans are fairly short-term loans. I'm talking about the value-add bridge lenders. They're, 2 to 3 year loans. And a lot of times you've got to buy interest rate caps. And some of these interest rate caps can be $1 million, $2 million now because rates have gone up so much. So I think there's going to be a lot of forced sellers probably middle of this year and later where they can't refi their debt. They're negative cash flow. They can't afford a interest rate cap because they didn't budget for it. And so we see a lot of distress happening May, June of this year as that, LIBOR SOFR spikes up to close to 5%.
Mm-hmm. And that's when the market will naturally start to adjust itself because the sellers are just going to have to be on the market there at the whim of the buyers. Exactly. And a lot of exchanges are drying up too. So it's not you have emotional exchange buyers where they have to transition or can for the tax basis. Now fresh equity coming to the table buying an asset from someone that has to sell. That's where the rubber hits the road.
No, you brought up a good point, which is, the exchange buyers, it's dependent on a very active transaction market. So they sold their down leg. They're in exchange. Yeah, they sold at a little higher cap rate, but they're forced to go buy a newer building and pay the higher number. And what we're seeing in these transactions today is, there's always this outlier exchange buyer, someone that has to buy that's driving the market. At some point, those exchange buyers are going to go away because they didn't sell their down leg at a great price. So that's why we're in this weird market today where there's not a lot of transactions because the numbers don't pencil. The sellers don't want to accept a higher cap rate. And but by mid this year, it's going to force a lot of sellers who either have negative cash flow, loans maturing, got to buy a rate cap and it's $1 million. So we expect a lot of distress to hit kind of mid this year when you get more of the forced sellers to happening.
Yes. I couldn't agree more. That's exactly what we're seeing on our side. So with these times of uncertainty, what are you doing personally? What is Bascom doing? Mm-hmm. What are you doing to really, kind of pivot and change and to become proactive in this? Or are you just sitting back and waiting? Are you still writing offers? Are you still trying to get principals to come to the table today? Or is it just going to be like, hey, May, June, it's another 3-4 months where we just kind of sit around and wait. But, and then another part of that question too, as far as your investors go, as far as the fund and whatnot, are they getting scared and want to pull back, or is it harder to raise capital from them?
Good question. It's as far as capital raising, it's probably the most difficult environment today. Most private equity investors say, well, I'm pencils down. I'm going to wait for this crash, right? Or, why jump in now? Get what I think is a good deal. 6 months later, it's not a great deal. So there's a lot of capital sitting on the sidelines waiting for the distress. Our fund investors, they're nervous too. And one of their challenges as well is bonds have dropped, stocks have dropped. So all of a sudden, they don't have as much money to allocate toward real estate. So that's a combination too, where everything's deflated in value. And so they have less money to allocate to real estate. But it's definitely going to hit. Rubber is going to hit the road middle of this year. And right now, a lot of people go, "Well, I'm going to wait keep pushing rents up. Hope my interest rate declines, the debt market gets better. Hope conditions improve. But as we enter a recession, maybe rents decline, higher vacancy, maybe our NOI starts going backwards. So there's a lot of negative kind of big picture things that start happening. And if job layoffs happen, rents will go negative.
Right. And we're seeing that obviously up in the Bay Area where the layoffs in tech have been pretty significant. Southern California is, I think, much more of a diverse economic base down here.
Sure.
But you look at other parts of the Sun Belts and whatnot, and recently even, in parts of the East Coast and whatnot, they're starting to see those layoffs happen here and there. And it's going to really take a foothold on the ability to raise rents, number one, the vacancy factors, number two, which in turn, obviously higher costs too, utility costs, gas costs, electric costs, insurance costs. Now in LA County, they're doing this additional tax on any kind of sale of an asset. I believe it starts April 1st.
Yeah, the transfer tax.
The transfer tax.
Mansion tax.
Whatever it is. So if you have a property between $5 to $9 million, it's an extra 4.5%.
Sure.
And then 10 million plus, you're 5%. So that could, on a $10 million deal, $500,000. I've spoken to some investors, up there over the last month, and they just said, well, I don't know what's going to happen there because the amount that hits your equity and the bottom line on the rate of return. Yeah,
that mansion tax has been a big crusher for LA. And not only do we have people not paying rent for 3 years now, they extend the eviction moratorium another 2 months. So you have less people paying rent. And if you sell a building, you have to pay 5% of the sales proceeds, which is a big hit to your equity. So underwriting new properties in LA, you can say, well, the eviction moratorium is going to end. It's back to normal at some point. We can say that, but the lenders go, I'm going to underwrite on current income. So if people aren't paying, that's my underwriting income. I'm not going to bank on it going away in the future. So you get a lot lower leverage in LA because people are nervous about this eviction moratorium. I mean, most people believe it's going to end, but the transfer tax is a real hit. We might have a property that shows a 16 IRR before they pass that law. Now it's showing a 14% IRR. So it's taking a couple percentage hit on the IRRs, which means you got to buy the property at a lower value today. So that mansion tax, probably cut prices 5-10% in LA. And then you got to build in lower rent growth because of recession. So LA, maybe it's a 15-20% decline in value with the mansion tax plus the other issues that are happening today.
Right, which is really going to slow that velocity there, I think, for the foreseeable future.
Sure.
Other markets that come back, like obviously San Diego, Orange County, Inland Empire of Southern California, moving outside of California, those markets will be more naturally moving. Now you throw that extra 5%, cog in the wheel there. Now it's like, wow.
It's a crusher.
So you just kick the guy in the gut while he's down on the ground bleeding.
Yeah, and you kind of wonder, why do you want to invest in LA? It's I was at a couple of years ago, this is pre-pandemic, and with a group of 20 or 30 apartment CEOs, and they spent an hour kind of griping about how bad LA is, and it's toxic, and you get sued, and you got rent control, and the guy said, well, would you rather buy in the Sun Belt? And they go, no, I'll stay here, right? Because LA, despite how negative it's become, has a lot of great factors, barriers to entry, and tight vacancy, and good projected rent growth. So there are positives. So we just have to get through this eviction moratorium, deal with the mansion tax and budget that. So
and LA, there's no land, right? I mean, that's the other thing too is. There's no place to go and build unless you buy something, bulldoze it, and pay all those construction costs and deal with the approvals of the city that you may or may not get in 3 or 4 years. But it's it's a challenge.
Sure.
So maybe from your standpoint, if someone who's looking to get into commercial real estate, either investing or whatnot, I mean, you've been through everything. You obviously have the credentials. You've done, like we talked about, almost 158,000 units. What would you recommend to someone? There's a lot of people on the show watching are not, top executives and whatnot. We want to try and help younger people too in the business. What would you recommend to them starting out or maybe being a few years in the business?
Good question. I think I would recommend that get as much education as possible. So, myself, I went and got a master's in real estate at Wisconsin, #1 real estate program. I did that. I didn't know it was a great program. I was just there and happened to go to school there, so I got lucky. But one is get a good real estate education at top school. Two is, as Michael said, when I was younger, I had this fascination for learning about real estate. So I took the CCAM, got my designation. I got the CPM, which is the property manager designation. I got the certified turnaround professional designation. I got all these designations because I love learning about real estate. And it's great when you're younger because you have the time to do it. When you get older and married and kids, it's tough. So the key is go out and get as much education. Two is, one thing that we've done for Bascom Group is be very big on internships and mentoring young people. So we've had, I think, close to 200 interns over the years. We've got 4 or 5 working with us currently.
That's
and
great.
They rotate out. They get a summer job. They leave us to. It's kind of a program where we say, come work for us. You could be graduate, you could be in school, and work with us as long as you'd like as an acquisitions analyst, and look for a job while you're working for us. And if you get a job, you move off
Right.
To another company. So I think it's trying to get good internships. And how do you find those? You go out, network, call people,
Yes.
cold call them, whatever it takes. Go on LinkedIn. And then 3 is probably find mentors in the industry, whether it's Michael.derk or people like that. Reach out to them. I've had probably 50, 80 mentors or mentees over the years. And how did I find them? They found me.
Right.
I signed up for, University of Wisconsin's mentorship program. I get a few there, but most of them, surprisingly, cold call or cold email me and say, hey, Jerry, I'd love to talk to you. And I try to make the time because I look back and go, 25 years ago, that was me. I didn't do it, but I should have done it.
Right.
And if I can spend time with them to educate them, give them some career advice, I actually enjoy it because I like to see their success in life and see them do well. I've also partnered with a lot of younger people too, where they, might have been in their 20s, late 20s, 30s, and were looking to buy multifamily. I said, hey, I'll be your equity partner. And so I've done a lot of mentorship with younger people buying real estate. And it's a great way for me to kind of be in the game, but I'm not doing the hard work. So
Right.
I love that as well. And, so far they've all done pretty well. So,
That's great. And my hat's off to you for that, because a lot of people get to a certain point in their career and they don't, not that they maybe don't want to give back, they just make an excuse on the time. And
Sure.
I mean, first and foremost, I can tell you first, we want 40 hours in a day and 12 days a week would be a perfect, scenario. But
Sure.
as busy as you are, and that ability to give back and be so philanthropic for younger people in the business is just priceless. So
Thank you. I like it because it energizes me.
Right.
When I meet a younger person, I go, wow, that was me, 25 years ago. And so it gives me a lot of energy seeing the enthusiasm and desire to learn from the younger people. And my goal also is to make money doing it. So I'll invest with them and say, hey, let's go buy a value-add apartment together. And I do that as well. So
That's a twofer.
I learn a lot from them. I mean, the younger people
Right.
have a unique way of thinking. As I get older and, beat up and stuck in my ways, I meet younger people that teach me all these new things that I wouldn't have known because they didn't have any preconceived notions. I've partnered with investors that said, I've taken a 1-bedroom, made it a 2-bedroom. I go, how'd you do that? I said, well, I framed out the living room, put a window, had a window and door, and I created a 2-bedroom unit. And I started thinking, I never would have thought of that, right? And today's youth, they'd rather have their own bedroom. They can go pop open the laptop, watch Netflix. I grew up in an era where we all sat in the living room and watched cable TV.
Right.
And so I learned these things from younger people about, things I never would have thought of.
Sure.
So,
yeah, no, that's great. And it's great to be able to have the synergy to learn from each other. Transitioning back into deals, I kind of looked at this morning, but our team with you, so graciously, we've closed almost 40 deals over the years together, and it's been excellent. We're very thankful for that opportunity. Sure. I'm just curious, maybe in talking to the audience, why hire an intermediary, maybe like, mortgage banker like myself and my team, versus just going direct to one lender in the market today? Where do you see that value? And, I guess, if you maybe touch on that a little bit.
Yeah, good point. This will be a sales pitch for Michael.derk, but we've always, for our company, relied on, let's go hire the best vendor. So let's go hire the best property manager, most number of units, most number of experience. If we're going to get a loan, let's go find the best loan broker, and let's go find the best specialist in every little focus in our business so we can build the best team. And where I see the biggest challenge with owners, they think, oh, I'm going to save the point, mortgage brokerage fee and do it myself. Well, they call a handful of lenders and get a quote that's lower leverage, higher rate. You end up paying more in debt service costs than you would have if you hired Michael.derk. And I've learned too, the debt markets are always changing. There's always new players, and you need someone like a Michael.derk and his team to go scan the market, find the best deal, and find the best execution for us. So we've always done that. I've never tried to call people direct and save the fee, because if I did that, I'd find myself paying more
in the long
run than my little savings would cost.
Yeah. So, and again, I appreciate you talking about me and my team, but I really want to kind of talk about it in general of what that value is as an intermediary in the market, because even us and my counterparts, it's just not me and my team. Being with, Mark Small Cap Capital, I have about 200 counterparts across the U.S. We share all this information on a weekly basis, which isn't even enough. If we did it every day, it's not enough. So being a principal that's in the market, getting a deal every 3-4 months, you think you're, on top of it, but it takes, an army to just get that tip of the iceberg to understand who's in, who's out. And so hopefully a lot of the people watching the show would understand that the market is moving so fast today, and you really have to be proactive and make sure you do have the best team assembled, whoever that may be across the United States. So, kind of in a wrap here, as far as goals for Bascom and maybe just for Jerry Fink as an individual for 2023 and looking into 24, what does that look like? What do you have going on? Yeah,
I think big picture, our goal for Bascom Group is we'd love to buy $500 million of new properties in 23, and it's a lofty goal. Will we hit it? We'll see, but I think it's going to be a little slow, maybe the first quarter, second quarter, but I think the third and fourth quarter are going to be a big year for us, because that's when the interest rates peak and loans come due. And I see the biggest amount of stress happening middle of this year. So, hopefully we're ready for it, and hopefully our equity partners are good to go.
Right.
But I see a fairly slow period here the next quarter or two. But by second, third quarter, I think the transaction velocity picks up. As you said, Michael, it's not that they want to sell, it's they're forced to sell because loans are maturing, negative cash flow, multi-million-dollar interest rate caps, a variety of things, and loan paydowns. All these things are going to hit probably mid this year, and so we see a lot of distress happening. And second, it's not just the financial distress that's happening. It's people are going to start seeing negative rent growth, higher vacancy, so their NOI is going to start declining, especially top-line rent growth this year. So I think people realize, I might have missed the window. I better sell. And by the way, my lender's calling my loan due. So a variety
or they
of
may not be the best operator too that they thought they were. As the market's on a tear going up, everyone's a hero, everyone's smart. You bought a deal, I made 20% a year. Look at me. But now it's like, whoa, everything's flat. My costs are going up. I can't raise the rents. Oh, geez, my debt's coming due. How much of a maybe big shot I am right now, you find that out, and maybe apartments aren't the darling at that time. It's another investment, but there may be not even real estate, but like you talked about, stocks and bonds and other areas of investment have taken a hit. They may have to sell assets in order to shore up other parts of deals of construction or whatever it may be in life. So, I think that's what we're going to see. One last thing too, are you starting to, or maybe you started doing this last year, are you doing bridge facility, like a bridge to normal? We've had some clients where they put short-term debt on for maybe the next 2 years, thinking that interest rates are going to be ticking down and the market's going to normalize, or are you just kind of riding things out?
Good question. We haven't done that in the past. We've typically got a bridge loan and said, hey, when it matures in 2.5, 3 years, it matures. And that's when we'll sell the property. So we'll buy it, reposition it, and then go sell it or refinance it. So we haven't done a bridge to perm yet, even though it's pretty common. And our view is we'd rather just wait at that point and then determine what our outcome will be.
Sure. So you'd be open to maybe a bridge to bridge that you've seen, and sometimes people are doing that.
Exactly. Because your bridge loan comes due. But, But the bigger challenge is going to be when these bridge loans come due, the lenders are going to say, I want a multi-million-dollar pay down, and most partnerships don't have the resources to do that. So that's going to force these sales to happen.
Sure. Yeah, budgeting for capital calls is those are tough calls to have because future investments will become very difficult then when you miss it on this one. So
Exactly.
I think that's all we have today. Jerry, I cannot thank you enough for coming. Jerry Fink, ladies and gentlemen, is definitely a titan of the industry. I'm very thankful that he was come here today and share what's happening in the market and what he's doing to be successful and whatnot over the years. So I hope you enjoyed the show and have a great day. Thank you.
Thank you, Michael.